Good afternoon. We're going to present what is a financial statement analysis. The team is formed by Roberto Leon Zamora and Lawrence Sebastian Poof. So, as an introduction, financial analysis is a process of examining a company's performance in the context of its industry and economic environment to arrive at a decision or recommendation. It focuses on evaluating the company's ability to earn a return on its capital, profitability, grow its operations, and generate enough cash to meet obligations and pursue opportunities. Basic financial statement analysis provides a foundation to better understand information gathered from research beyond the financial reports. So we have to understand that financial analysis give us a lot of information about the financial health of a company, and it is not just numbers and percentages. We also need to analyze them so that we can make up decisions and improve the performance of the company. Scope of a financial analysis. The financial reporting is used to provide information about a company's performance, financial position, and charges in financial position to make economic decisions. Financial statement analysis is used to evaluate the past, current, and potential performance and financial position of a company for investment, credit, and other decisions. Examples of these decisions include the following: evaluating an equity investment for inclusion in a portfolio, determining the credit worthiness of a company in order to decide whether to extend a loan to the company and if so, what terms to offer, examining compliance with debt, covenants, or other contractual arrangements, and forecasting future net income and cash flow, assigning a debt rating to a company or bond issue. So now that we have these examples, we can be able to know that it's important to have a good analysis so that we can make up good decisions and that are more adequate to the needs of our company. Analysts examine a company's past and current performance and financial position to form expectations and asset risks. Profit and cash flows are not equivalent. Or as profit or loss equals income minus expenses, and its recognition is independent from when cash is received or paid. Analysts collect information from outside the company, such as economic statistics, industry reports, trade publications, and databases, as well as from the company itself. These statements summarize the accounting information mainly for users outside the company, such as investors, creditors, analysts, and others. So, analysts are a key part in this equation because it is important to have a person that knows how to get all the information possible from any database, from any income statement, or anything that is useful in the company. Balance sheet. The balance sheet portrays the company's financial position at a given point in time. The statements of comprehensive income and a statement of cash flows present different aspects of a company performance over a period of time. The statement of changes in equity provides additional information regarding the changes in a company's financial position. Then we have to articulate the purpose and context of analysis. Prior to undertaking any analysis, it is essential to understand the purpose of analysis. An understanding of the purpose is particularly important in financial statement analysis because of the numerous available techniques and the substantial amount of data. When facing a substantial amount of data, a less experienced analyst may be tempted to just start making calculations and generating financial ratios without considering what is relevant for the decision at hand. It is generally advisable to resist this temptation and thus avoid unnecessary or pointless efforts. So that's also based on the point that we saw in the slide before, If you have a good analyst, then we're not just going to take all the information that is in front of our eyes. It is important to know what is relevant in that information and what can help us to work to improve in something and give better decisions. Then we have to consider questions. If you could have all the calculations and ratios completed instantly, what conclusion would you be able to draw? What questions would you be able to answer? What decision would you answer support? Who is the intended audience? What is the end product? For example, a final report explaining conclusions, any recommendations, what is the time frame, what resources and resource constraints are relevant to complete of the analysis. Always after we have a good statement analysis, we have to still make more possible questions so that we have a less risk of not have like all the problems solved, and we give at the end a good financial analysis. And then, once the data have been processed, the next step critical to any analysis is to interpret the output. The answer to a specific financial analysis question is seldom the numerical answer alone. The answers to the specific analytical question may themselves achieve the underlying purpose of the analysis, but usually a conclusion or recommendation is required. If you want to have a good analysis, it is important to give conclusions because it doesn't matter if you present the procedures or maybe some questions or all the data that you explored in the process, but if you don't make any recommendation, then your analysis is going to be based in nothing. You need to start giving your opinion on what should be done after all analysis. What can you improve, what can you do for having more revenues, more profit, or to avoid losses. But that is really important for a good analysis financial statement. Thanks for listening, and that's all.